Anything. Financial management. My name is Wycliffe Makori. This is my official number in case you have any question, any clarification, or any concern. You can reach me on that. So I'll start by giving you the course outline. As it is the norm, we need to understand what are these topics that we are going to handle in this unit of financial management. So the following are the topics. One is the introduction. To financial management, which commonly we refer as FM. Introduction to financial management will be our first topic. Our second topic will be on financing. The financing decisions. Okay. So the second topic is financing decision, which is also known as the sources of finance. Financing decisions, we also refer to it as the sources of finance. Topic number 3. Will be all about the time value of money. The topic to do with the time value of money. After time value of money, we shall go to number 4. Topic number 4 will be on investment decisions. Investment decisions. After investment decisions, we shall go to number 5. Number 5, we shall cover the capital structure. The capital structure and cost of capital. Capital structure and cost of capital. Then number 6. Financial markets or financial institutions and markets in Kenya. Financial institutions and markets in Kenya. Number 7. It will be a topic to do with working capital management. Working capital management. Working capital management. That is number 7. The working capital management. Number 8. Topic number 8 will be about budgeting and financial forecasting. Budgeting and financial forecasting. Number 9, we shall cover the ratio analysis. Ratio analysis. And then we shall wind up with topic number 10. Number 10 will be international financial management. International financial management. And that is all that we shall cover here. So on the first topic, we shall introduce what is financial management, what is the motive of having the financial management, what is the functions of the finance manager, among other areas. We shall just introduce the unit. Then topic number 2, remember we are talking about financial management. You are managing the finances. You are managing the finances. So those finances that you will be managing, where will you get from? Or what are the sources of those finances? What are the sources of those finances that you will be managing? That is what we call the financing decisions or the sources of finance. Then we shall talk about the element of time value of money, which simply states that the value of money changes as time goes by. Okay, Adam, shortly, I'm going to give you the permission. As time goes by, the value of money depreciates. An item that you used to buy maybe 20 shillings 10 years ago, right now, maybe you are buying the same item at 50 shillings. There is what we call time value of money. As time goes by, the value of money diminishes. So we shall have a whole topic to discuss about that. If you have an amount now, what is its equivalent maybe some years to come? If you expect some income some years to come, what is its equivalent right now? So under time value of money, we shall be talking about the future value and the present value of amounts. Then we have got the investment decisions. You want to invest the finances that you have in long-term projects. So how do you evaluate that? I understand in the QT you did that. You did some element of the net present value. We shall pick from there and get into more details about the same. How do you evaluate viable investment decisions from those which are not viable? So we shall have the whole topic of evaluating the projects. Capital structure and the cost of capital. Capital structure here, we mean the sources of capital for any business is either you raise your own money in the business, that is what we call equity, or you borrow, what we call debt. So we shall be talking about here the proportion of equity and debt that you have in your business and the cost. Because any finances that you are going to raise, whether through equity or through debt or through borrowing, those finances will come with a cost. We shall be calculating the cost of the finances. Anybody who is going to give you equity or buy shares in your company, those people demand dividends. And the dividends that you are going to be paying annually becomes the cost of the finances that you got from them. If you acquire the capital through borrowing, through debts, you'll be paying interest. So interest becomes the cost of the capital that you are going to incur. That is the whole topic about the same. We shall also be talking about the financial institutions and markets that we have in Kenya. And financial markets, these are the platforms through which exchange of financial instruments occurs. The sale of shares, the bonds, the money market, all those are financial markets. So how do they operate? How are they regulated? Topic number 6 will give us more information on that. Then we have got the working capital management. Working capital management is simply current assets minus current liabilities. That is working capital. If you take all your current assets, you subtract your current liabilities, that is working capital. And here we shall be focusing on actually 3 things. How do you manage cash, which is a current asset? How do you manage inventory, which is a current asset? How do you manage the receivables and the payables? That is under the working capital management. Then we have got budgeting and forecasting. How do you determine the level of operations in the future? That is budgeting and forecasting. We shall be preparing budgets here. We shall be preparing budgets here. Then the ratio analysis, which is now the financial statements analysis. How do you analyze your financial statements? You have prepared your income statement. You have prepared the statement of financial position. How will you get clear insights about your performance? You will do that by computing the ratios. Then lastly, we shall finish by making a comparison between the local financial management and the international financial management, and we shall be done. So that is the journey that we have. We shall start here all the way to here. The order might not be the same, but by the end, we shall have covered all those particular topics. So we give Adam maybe 5 minutes for prayers, then we continue. We begin with the first topic, which is on our introduction to financial management. So I have the notes. I don't know, those who are doing the evening physical classes, you need to take my number. The class rep have my number so that I can be able to share these notes with you. So these are the notes for the introduction to financial management, and I want us to learn through them. I hope they won't take us long because it is not something complicated. It's just introducing so that you can have an understanding of what we shall be doing. So when we talk about financial management, we are having actually 2 key terms there. We have got the term financial and the term management that are linked now together to form the financial management. If you start by looking at the management, I know you have a whole unit to do with the PPM, Principles and Practice of Management. Management is a process that entails planning, organizing, directing, and controlling. From the management point of view, those are the functions of management. Planning, organizing, directing, controlling. Sometimes we also have the staffing and all that. Now, that is management. But here we are talking about financial, not the general management. We are only talking about the financial management. How do you have or put in place the proper management policies when it comes to the issues to do with the financing? So that is why the definition is captured as it is the strategic planning, organizing, directing, and controlling of financial activities. We are not interested in any other. Our interest is only on matters to do with the finances, and matters to do with the finances is all about money. how do we manage the finances that we have? So you plan on how you are going to get those finances. You organize on how you are going to use them. You direct them to the investment that you have determined to be viable. And then as you do that, you need to control, making sure that everything goes well, making sure that you don't actually waste the finances in the process of running the business activities. That is the financial management. So when we talk about it, we have got the nature and scope of financial management. What is financial management and how far does it go? In terms of nature, it is interdisciplinary. Interdisciplinary in the sense that it combines principles of different disciplines that are linked with financial management. Those are economics, accounting, and management. I've talked about the issues of the process of management and the management steps or procedures. So we have got management, accounting, and economics. Economics here, it is because the resources are scarce and we need to economize them. So economics comes in. And then we need to account for every single cent that we spend. Accounting comes in. And that is why we have the ratio analysis, so that we can be able to do the accounting statements analysis. And then also there's the aspect of management. So all these three are interlinked. That's why we say financial management is interdisciplinary. Then it is also dynamic. It changes with the changes in the business environment, economic conditions, and any financial innovations that we are going to have. It is not something static. What actually worked very well last year might not work this year because the environment might not be the change, might not be the same, sorry. The economic conditions might not be the same. Things like the inflation, the interest rates, they keep on fluctuating. That is why we are saying when it comes to financial management, it is normally dynamic. Every financial environment will require certain specific ways of managing the finances. Then it is goal-oriented. At the end of the day, remember you are managing the finances of institutions or organizations. Those organizations, they have got investors, those people who have invested in those particular business organizations, and their wealth at the end of the day needs to be maximized. If you buy shares in any company today, at the end of the day, you want your wealth to be maximized. You bought the shares at 2 shillings each. After 1 year, you don't expect that share to remain to be 2 shillings. It should grow maybe to 2.5 or 3 or 4, anything above the amount that you bought them. That is the wealth maximization of the shareholders. And we also refer to it as the capital gain. You invested by buying 2 shillings per share. You bought 1 million shares. That is 2 million shillings. So after 1 year, those shares, if I am to dispose of them, how much will I get on top of what I invested in that company? That is what we call the shareholders' wealth maximization. Then it is also going to involve some aspect of analytics. That is where you need to do some ratios to know whether you are improving or not, through some forecasting. This is how we have performed the last 2 years. The next 2 years, how do you see? Where will we be? And all that. And also it is decision-centric in the sense that it focuses on certain key decisions. How much do we invest? How much do we source? How much do we pay the dividends? And all that. That is about the nature of financial management. It is interdisciplinary, it is dynamic, it is goal-oriented, it involves analytical skills, and also it is decision-centric. Actually, you'll find that in all aspects of financial management, there is certain decisions that need to be made. And actually, those decisions now you'll find them under the scope. Under the scope, we have got the decisions. Like here, what are the decisions that will be made when it comes to financial management? Number one is investment decisions. Under the investment decisions, remember we have the whole topic on that. And this is a question, how much should we invest and in which project? And before you invest, you need to evaluate those projects. So allocation of capital to profitable ventures is what we call investment decisions. But it involves analysis. It involves evaluation. We need to compute the net present value, profitability index, payback period, so that we can be able to know which project is most viable and which we can be able to get considerable profit from it. Financing decisions. We have got different sources of finances. We can get finances from loan. We can get finances by selling shares. We can get finances by issuing the debentures. We can get actually some assets through credit. All those are financing options. But which one is the best? Because we have said every source of finance will come with a cost. You get a loan, maybe it is a 15% loan, so you'll pay an interest of 15%. You get maybe your capital by selling shares of your company to people. They will buy those shares, but at the end of the day, they will be demanding dividends. So you need to look for a source of finance which is not going to be costly to the business organization. Those are the financing decisions. Should we raise the finances from option A, B, or C? You consider the cost, and then you should be able to come up with the correct mix. Then we have got dividend decisions. At the end of every financial year, we normally prepare the financial statements. These financial statements are going to reveal the amount of profit that we made in that year. Then, remember, we have got people who have invested in your institution who bought shares. They are known as the shareholders. They expect some returns from the profit that you have realized. And therefore, as a finance manager, you need to make what we call dividend decisions. And the dividends decision here, you need to decide how much of the profit will go towards paying the dividends and how much should you retain. Many companies, they don't distribute the entire profit as dividends. If I made or we made a profit of 10 millions as our net profit after tax, we cannot take the whole 10 millions and give out to our shareholders as dividends. So we can decide, for example, let us issue the 8 millions to dividends, and then we remain with the 2 millions to continue expanding our business. It doesn't make any financial sense. You distribute the whole profit as dividends, and then come the following financial year, you start borrowing. So distribute a certain percentage or proportion of your profit as dividends, then retain some amount which can be used to finance some projects. Those projects in future, they will start generating profit. So as you reinvest part of your capital, you are assuring your shareholders that in future, their dividends will keep on growing. Even their price per share will also be growing in the market because of the diversification and the investment that you'll be making as a result of the profit that you have made. So dividend decisions, therefore, they entails deciding from the profit that you made, how much should we give out as dividend to our shareholders who bought shares in our company? How much should we retain to continue financing the business operations? Then there is also the issue to do with liquidity management. And the liquidity is to ensure that you have got enough finances for your short-term financial obligations. You need to operate. You need to pay some salaries. You need to pay some wages. You need to pay rent. You must ensure that at any given point, the business is liquid, meaning that it has got enough resources to finance the day-to-day activities of the business. And if the business is not struggling in any way to pay the wages, to pay any utility bills that fall due, then that particular business, we normally say that it is liquid. It is liquid. But remember, it is not also healthy to be having a lot of cash that is idle. Liquidity does not mean that you should have millions and millions in your current account to finance those recurrent kind of expenditures. You need to have a proportion that is enough, but not excess. When you have got excess liquidity, then it simply means that you are missing some investment. Remember, when it is in liquid form, it does not gain. So the excess amount that you have should be put into investment, which is long-term. It is through investment that we normally get income. but liquidity per se, it is not that healthy. So you should only have enough, but not excess. That is what we are saying. Then the risk management is another area that is covered by financial management, whereby we need to identify the potential risks that can affect our business operations and look for ways that we can mitigate them. You can analyze your business and you see that maybe in the next like 3 months, we might have some shortages to do with finances. So that is a risk that is imminent. So what do you do as a finance manager? You start looking for finances so that after 3 months, you don't have that particular problem of financial risk. So you identify the potential areas that your business can be affected and look for ways through which you can mitigate those risks. Importance of financial management. We have number one, it ensures adequate finances. So at any given time, we have got or we have made the financing decisions and we have determined the adequate funds that we need so that we can be able to run efficiently. It also optimizes the resource use, and this simply means that it prevents wastage. It promotes efficiency of resource utilization. Another importance is to do with the support strategic planning. It facilitates the strategic growth of your organization because it is going to have a proper planning and control of the finances with the sole aim of improving the future growth of that particular business entity. And through proper financial management, we are going to improve on our profitability because we are going to monitor on our costs and look for ways through which we can maximize the revenues or returns. Then on the issue to do with financial stability, we are also always going to have a cash flow that is very stable. We are going to have a cash flow that it is very, very streamlined. We don't have a case whereby at some time we are going to experience some shocks in terms of the cash flows. And then lastly, it's about facilitating investments. Once you have a proper financial management in place, and then there is some level of transparency on how finances are raised and utilized, obviously, many people will be interested in joining your business organization by acquiring shares, and therefore, more investors will be attracted in any business that is having proper financial management. On the roles of a finance manager, those roles are divided into two. We have got those roles which are routine, and we have got those roles which are managerial in nature. Those roles which are routine are the roles of, yes, a finance manager, but they don't require specialized skills. They don't require specialized skills. And actually, anybody with a little or small training can be able to handle this, like preparing the reports, managing the cash flow, overseeing the payroll, doing some simple budgeting, and monitoring the accounts receivable and payables. Those are routine, and they normally occur on a regular basis or continuous basis. But when we get to the managerial roles of a finance manager, these are now specialized. Not anybody can be able to undertake these roles. It is only those people who are skilled on financial management that they can be able to handle this, like financial planning, sitting down, having a very good long-term and short-term financial plans. That one, nobody or not everybody can be able to undertake that. The issues to do with investment decisions, evaluating different investment options. You calculating the NPV, IRR, ARR, payback period. Not everybody can be able to do that. It is only a finance manager who is skilled in that particular area. Coming up with the correct capital structure, the debt and equity that you are going to use to finance your operations, that is financing decisions. That is another one. Coming up also with the correct dividend policy or formulating the right dividend policy, whereby you balance what goes to the shareholders as dividends and what you retain. It is also another area that is under the managerial roles of a finance manager. Not everybody can be able to undertake that. Risk management also. Not everybody can be able to analyze the market risk, financial risk, environmental risk. It is only those people with financial management skills together with the advisory roles to the management. So those are the roles. So sometimes in an exam, you can be told, explain 5 managerial roles of a finance manager. So you only need to highlight the managerial roles. But if the question is open, just setting, explain 5 functions of a finance manager, then you can mix the routine and the managerial. But when it is very specific, just stick to the category that you have been asked to explain. Financial goals of a firm. Any organization will have the following goals. Number 1, it is profit maximization. And profit maximization, it is normally the short-term goal. And when we talk about profit maximization, it is simply a matter of making sure that the revenues are very high, but the cost of operations are low. If the cost is low, but the returns or income is high, obviously your profit is going to be maximum. Managing the costs and also ensuring that you have got enough streams of income to your organization, it will have or it will make your profit to be maximized. When we talk about wealth maximization, it is now increasing the value of shares of a company. And it is the primary goal. Actually, any organization should actually operate with the motive of wealth maximization, not profit. Wealth maximization. And when we talk about wealth maximization, if you buy shares today, maybe of Safaricom, at maybe 15 shillings per share, for your wealth to be maximized, those shares should appreciate in their price in the market. You acquire it at 15. After 1 year, it has gone to 17. Your wealth is being maximized. Because every share that you bought, it has increased by 2 shillings. Another 1 year, they now go to 19. That is what we call wealth maximization. And that is the best way of earning from any company. Not just the profit. You know, from the profit, you get the dividends and you forget about it. But when you talk about wealth, the value of your shares keeps on appreciating. And your wealth in that case will be increasing or being maximized every year. And it will be very nice. If you buy shares at 10 shillings per share, after maybe 5 years, they are now selling at 30 shillings. Your wealth have been maximized significantly. If you decide to sell those shares, you will get very good returns. Because you bought them at 10, you are now selling at 30. Every share that you sell, you will be gaining 20 shillings on top of what you invested. And that is why anytime an organization has made a profit, that is normally the short term. Part of that profit should be reinvested back. When the investment occurs through the retained earnings, the wealth maximization will continue being created. You diversify, you venture into new markets, you open a new branch. That is now going to lead to profit maximization. Your value or the value of the shares will be maximized. Then we have got the return on investment. That is optimal returns from the capital that you have employed. The other one is the goal of ensuring that there is liquidity and solvency. I've talked about liquidity. Liquidity is the short-term ability of the firm to pay its obligation. The ability of the organization to pay short-term expenditures as they arise, that is liquidity. But when we talk about solvency, we are talking about long-term stability or long-term obligations the business has. Are we able to pay our 5-year loan that we have with the financial institutions? Are we able to pay the bond that will be maturing after 10 years from now? That one is what we call solvency. It is normally long-term. But short-term is liquidity. Are you able to pay your short-term bills in good time? That is liquidity. It's another goal. And then maintaining financial efficiency, making sure that as you operate, you realize your goals with the minimum cost possible. That is efficiency. If you are able to achieve your goals at minimum cost, then you are operating efficiently. Lastly is a sustainable growth, balancing profitability with environmental and social goals. You know, any business organization is operating within the context of a society. As you operate, you should not actually grow at the detriment of our environment. You should not pollute the environment just because you are growing like that. So as you grow, make sure that you are environmental sensitive, you don't degrade the environment, and also the social goals or the societal goals are also taken care of. So we should not have maybe an organization that, yes, it is growing, but as it grows, it makes the environmental worse. That is not sustainable growth. Sustainable growth, yes, grow, but the environment is kept safe, and also the society needs are well catered for. So the last area that we shall discuss, but it is quite a lot, I don't know whether we are going to finish it. It is about agency theory. Agency theory, an agent. I know you have done business law somewhere, and there is a whole topic about the role of agency. Agency occurs whereby we have got one party, which is normally known as the principal, who delegates his or her authority to another person we refer as the agent. And the agent now will be acting on behalf of the principal. So you have a responsibility to do. You are now the principal, but you decide to delegate that responsibility to somebody else to do that responsibility on your behalf. The person who will be doing that responsibility on your behalf becomes the agent. Becomes the agent. So under the financial management, we have got those kind of relationship. A particular institution or level of management delegates the duties to another person to be able to do those particular roles. So it creates what we call the agency relationship, which we are going to look at them here. But those agency relationships, they are going to come with conflicts. Like agency relationship number one, it is the shareholders and management. What is happening here? The shareholders are the owner of the company. They bought shares, and that is why they are shareholders. But because they lack managerial skills, they hire experts in the name of management to run the business on their behalf. So they have delegated their duties to the management to run their business on their behalf. The board of directors, the chief executive officers, and all that. They are people who are mandated to run the business on behalf of the shareholders. If you look at any big company, it can be a company like the East African Breweries. We have got so many shareholders, but those shareholders, they don't take part in the day-to-day running of that company. They have delegated those particular responsibilities to another set of team. We call the board of management or board of directors to run that particular business on their behalf. So the shareholders, because they are the owners of the business, they are the principals. They have delegated the duties to the management. So the management becomes the agent. But as now, the agent serves or does the activities on behalf of the principal, we are going to have some conflicts that will arise. Number one, this particular management team can actually exercise what we call excessive salary increments. They can decide to award themselves hefty salaries, but at the expense of the shareholders, which are not justified. So it creates a conflict. It creates a conflict whereby now the management and the shareholders will conflict. Why are you awarding yourself this big allowances, which are not justified. So quarrels will arise. Another conflict will arise as a result of perquisite consumption, whereby the managers enjoy personal benefits like luxury offices, the cars that are financed or are fueled by the company, and all that. It becomes also another conflict area. Then we have got what we call empire building, where managers may pursue unnecessary expansion to gain prestige or power and not shareholders' value, where the companies just expand. But as they do the expansion, they don't have the interest of the shareholders at their heart. They are only doing that so that they can be seen to be doing very good job or for prestige, but the interest of the shareholders. Remember, the shareholders, what they want is wealth maximization. That is not their motive. And also, number 4, where they focus more on short term and not on the long term. Remember, we said the shareholders' wealth maximization will arise well when we do long-term growth and investment. So if they only look at the short term and then they neglect long term, then it is also going to bring some conflicts. Lastly is the resistance to takeovers. And here it is where the managers may block mergers or acquisition to protect their jobs. But some mergers might be very beneficial to the shareholders. But when they know if we merge with company B, we are going to lose our jobs, they are going to make sure that they block those particular mergers so that they can remain to be the managers in that particular business without considering the interest of the shareholders who are the principals. How do we solve those conflicts? Number 1, the management should be given what we call performance-based compensation, whereby they are paid based on how they have performed. How they have performed. The better you perform, then you get a good return. Then independent remuneration committees, whereby paid decisions are made fairly without management influence. We don't give them the roles of awarding themselves hefty allowances and all that. Then also during the AGM, the shareholders, they have rights to vote. The shareholders might, at the AGM, the shareholders voting rights empower the shareholders to approve executive compensation and strategic decisions. That is when they are having the AGM. If they wish to award them some increments in the allowances and compensations, they should table those in the AGM so that the shareholders can be able to approve through voting. And regular and transparent reporting, make sure that the reporting is made very transparent, and then the board oversight. We should have a strong independent board that can hold the management accountable for every decision that they make. That is one of the conflict area, the shareholders and the managers. Then we have got now the shareholders and the creditors. Here, the creditors will be the principals, because the creditors have given their money to the business, and the business, therefore, it is utilizing the creditors or the financiers' money. If I give you my money, then I expect that you will use that money prudently in a way that you had or we had agreed, so that you can be able to pay me back at a future date. I will not give you money and then I look at you waste my money. So that is what we are simply talking about here. Some of the sources of finances, they normally come with what? With some restrictions. You are given finances to buy motor vehicle, and you cannot use that money for any other thing. You are given something like a mortgage. It is either you buy a house or you build a house. You cannot use that money for anything else. So the creditors who gave that money, they will be monitoring you to ensure that you have done as per the agreement that you had. So the conflicts will arise because of the following: risk shifting, whereby managers put the creditors at risk, in the sense that they invest that money in risky investment. Money has been borrowed, and then the creditors, they realize where that money has been invested. It is in an area that is very risky. Many other firms have invested there and they have actually lost the money. So it becomes now a conflict. They will start quarreling as to why that investment was made there. The other thing is about dividend payments. From the profit, if you have got any liability you need to pay, you need to pay part of the loan and all that. But you might, the shareholders might decide during the AGM that a bigger portion of the profit goes out to the dividends. Then these creditors will remain with a very small portion for them to be paid from. We have made a profit of 6 millions. Then the shareholders during the AGM, they decide that out of the 6 millions, 5.8 will go to the dividends. So then what remains is only 200,000. So the creditors will start worrying, getting worried. Is this 200 going to be enough to pay us back our money that we gave? Then we have asset substitution, where borrowed funds are invested in riskier assets than originally agreed, almost the same as number one. And then issuing new debt. Issuing new debt here arises whereby I have given you the debt. Then I realize that tomorrow you have gone to another person and you have already also acquired a debt from there. Then after another period, you have borrowed. So continuous borrowing from other institutions will create actually a conflict. It is the same case even at your personal level. When you realize that the person that you gave money on credit, that same person has borrowed from 5 different people, then you should get worried on whether you are going to get your money back. Because that continuous and excessive borrowing simply means that it is going to put you at risk. This person or business will need to be able to pay all these debts that is acquiring aimlessly. And that's why even you have here in Kenya, now the citizens, they start getting worried when they hear that the government of Kenya is making another borrowing. You start getting worried. Are we going to be able to pay all these debts? That is the same scenario that we are talking about. When a business entity to whom you had given some loan, and then it continues getting more debts. And that, it creates a very big quarrel. Then we have the underinvestment problem, where the money borrowed is not invested in a safe and guaranteed return kind of a project. Those particular conflicts can be solved using the following: having what we call debt covenants, whereby you restrict legally through the law on the dividends, payments, asset sales, and all that. The other one is convertible debt instruments, where you allow the creditors to convert their debts into equity. When you talk about converting from debt into equity, it is simply meaning that you convert them from creditors into shareholders. If I have given you money worth maybe 500,000, instead of you returning me the 500,000, you can give me shares equivalent to 500,000. So you have converted that credit into equity. It will also solve the problem. Then we have got secured loan. Every time the creditors will give out the loan, they also give or they demand the collateral, and they hold it. Things like the log books, things like the title deeds. Once they hold that, in case you fail to pay, they can be able to dispose that asset and recover their money. And then senior debt structure, whereby we give priority to existing creditors during liquidation. Liquidation is when the company or the organization is winding up. They sell all the assets. They should start retiring those assets or those particular loans or credits that were acquired earlier. And then frequent financial disclosures to keep the creditors informed about how the business is performing. That is about shareholders and the creditors. Then we have got shareholders and the government. You know, the government is the regulator. Any business that actually operates within the boundaries of a country, it must be regulated by the government of that country. So the government is here, it is senior, it is the principal, and then the shareholders who are now the owners of the business will be the agents. So the conflicts will arise on issues to do with the tax avoidance. Shareholders are not remitting the amount of tax they are supposed to. Environmental violations, you are operating the business and then your business is polluting the environment. Lack of observation on the labor laws, you are mistreating your employees and all that. The transfer pricing, manipulating the intercompany transaction, and also corruption and robbing. So basically, those conflicts will be solved in the following manner: enforcing the tax laws, observing the environmental regulations. Like here in Kenya, we have the NEMA, making sure that you operate within the confines of the laws of NEMA. Corporate social responsibility, giving back to the society. Participate in tree planting for free, participate in environmental cleaning for free, so that you can be able to avoid those quarrels to do with the environmental degradation. And also transparency in everything that you do, and incentive-based policies. And I don't know whether this is the last one. I want us to finish on this. The quarrels that will arise between shareholders and auditors. Sometimes actually not sometimes, always, companies invite the auditors to come and give their independent opinions on how the financial statements have been prepared. So because it is the shareholders that will employ the auditors, the shareholders are the principal, the agent here is the auditors who are working on behalf. Remember, they are checking to confirm whether the books of accounts are prepared in the correct manner by the management. So the auditors becomes the agent. And the conflicts arise here due to lack of independence. When the auditors are so close to the management, remember they are auditing the management, and when they are so close to the management, there is high chances that they might not give us the feedback that we want. If the management has erred, or it has made a lot of mistakes in terms of preparing the books of accounts, a lot of funds have been misappropriated, and these people are very close, that independency will actually affect the objectivity. That is one quarrel. Then the fee dependency, when the auditors may not report irregularities to retain a lucrative client. You remember, most of the management are the ones that may give you that job next year. So what do? You don't give a negative report about them, so that next year they can also call you and come and do the audit. Negligence or low quality audits, where they overlook some errors and frauds, and late reporting and failure to detect the fraud. You have given these people a lot of money to detect fraud, but at the end of the day, they ignore all the red flags, and then they give a very clean bill of health. Then that becomes a problem. Solution to this: do audit rotation, change them. Independent audit committees also include now the non-executive directors to oversee the auditors' relationships, regulatory oversight, limit non-audit services, and enhanced audit disclosures. Not forgetting, you report them also to the regulatory agency, like the ISPAC. Every auditor is supposed to operate within the confines of the regulations of the ISPAC. If they don't do so, then you can be able to report them to the ISPAC and their licenses can be revoked. So some of the challenges that we are going to face are those ones and conflicts. Any question? Anybody with a question? So basically that is what we need to discuss about the introduction. Understand the meaning, the scope, the nature, the functions of the finance manager, then those particular conflicts that we might have. So it brings us to that end of the topic. So when we meet next week, we shall first of all go to the time value of money. We do some computation there. So tell your friends to try and avail themselves. Because this one, if you understand, then automatically this one you will be able to understand. Any question? So if there is none, allow me to wish you a blessed night and also enjoy your moments. Asanteni sana. Let us meet next time. Thank you.
Bye, mwalimu.
Okay, bye.